This demonstration is designed to instruct you on using MetaStock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company.
My name is Adrian Manz, and today I want to talk about trading the around the horn methodology. You can read all about it in the books, and definitely Kelly's going to talk to you about the add-on for MetaStock. I assume a lot of you are here because you're already using the add-on, or because you've already read the book and you're already trying to implement this stuff. And today I want to sort of get into what the logic is behind it and talk about what the profitability has been over time, what the logic is for the Fastball setup, which is certainly the most prevalent strategy right now with all this market volatility that we've going on, and then talk about how it is that I structure the trading plan when it comes to actually taking these patterns and applying them to the market. So let's get started, and I'm just going to tell you about me for those of you who haven't been around me before, or who haven't heard about what it is that we do. I have been a professional trader for the past 13 years. My wife and I started trading right out of graduate school and never looked back, right? So we've been at this for quite a time and trade long short equities, primarily New York Stock Exchange stocks. In my hedge fund trading, I do also include NASDAQ securities, all based on exactly these same methodologies. This stuff applies to any market, and as we're going to see a little bit later, any time frame. So that's sort of the new portion of the approach right now, is a shift in from strictly intraday to also adding some swing trading to this. We have an intermediate and intraday holding period. We do 3 to 10 round trips per day on the day trades, and all of our entries and exits are pre-planned. So we know ahead of time everything that we're going to do. The core methodology that we use has generated an average 6-point return per month for the past 8 years. It's been very, very profitable. We have not had a losing month since we've been publishing the trading plan. It's a very solid methodology, and I think once you sort of look into the logic of how the thing works, you'll see why. Now, in terms of what somebody's going to ask, well, why do you report your results in points? It just makes it very easy then to apply it to your own situation and say, well, what would I be earning if I was trading this? So let's say a $100,000 trading account with 0 leverage, trading 1,000 shares, then 1 point is 1%. Similarly, let's say a $30,000 trading account, 0 leverage. If you were trading 300 shares, then 1 point would be 1%, right? Now, the entire around the horn methodology relies on the assumption that the markets are cyclical. And within that cyclical market, we can predict what's coming next, right? So we know what market cycles look like, and we know then that if we try to get on the same side as the market cycle, we can be on the same side of the trade as insiders versus trying to beat the market cycle and being on the retail side of things. So what around the horn is all about, and what the add-on for MetaStock does, is gives you a gauge of expansion cycles, contraction cycles, reversals, and resumption of trend, or the start of a new trend. So you sort of need to know what phase the market is in before you go looking for things. You don't just scan with MetaStock and say, gee, I really like this Fastball setup. This is all I'm going to look for. You go through, you flip through some charts, you look at what the sectors are doing, figure out what's going on out there, and then say, all right, well, when I run my scans tonight, or when I flip through the charts tonight, and I see a lot of, let's say, infield fly reversal setups, I know that those are going to be something that I focus on because that's what I see happening in the sector, right? So we're not trying to beat the market with this methodology. We're trying to figure out where the market is and what the market's likely to do next. Now, I've expanded on this and taken around the horn sort of a step further and focused on the volatility patterns and developed what I call a vertically integrated trading strategy in my new book, Trade Secrets, Powerful Strategies for Volatile Markets. These can also be scanned for with the MetaStock add-in. You're just shifting out into a different time frame with, say, the Fastball setup, which is an expansion of range and volume setup that we'll focus on a little bit here in a few minutes. But it also allows you to capture some heavy-duty market reversals in the form of what I call the sinker strategy. So there's this major part of this book that's devoted to a strategy that I've been employing now for the last 3 years that really only works when the market is making highs or when a stock is making new highs. Gets you into the reversal on that, sort of before the crowd, and it's really been an amazing pattern because over the time that it's occurred, we've had about a 90% success rate with it. Now, it doesn't appear frequently. It's a very infrequently occurring pattern, but when it does happen, it's very powerful. And that's this whole idea that I'm talking about in this book about vertical integration. It's all about, I'm not a day trader, I'm not a swing trader, I'm not a position trader, I'm a trader. So, if it's there and it works and it makes sense in terms of what the market's doing, I'm gonna seize the opportunity. So, most important to me when I'm looking at my methodology, when I'm looking at my the patterns that I'm focused on, is putting together a good trading plan, and that's what I'd like to talk about next here. When I go through every day and look for setups, I'm looking for those, the reason I named these things like Fastball and Infield Fly and all that was just so that they're easy to remember and they're easy for people who are following them to remember and sort of picture in their mind what it is that's coming up. Now, the more important than knowing what an infield fly is or knowing what a fastball is knowing what the logic is, right? I know exactly that if I've got a fastball setup, what I'm counting on is that I've got high volatility in the market. I'm expecting that volatility to foster more volatility. I'm also aware of the fact that for the setup to be valid, it had to close in the top of the range, which means there were buyers coming into the end of the day. I want to see pressure on the chart. I want to see volume going into the close. There's a lot of things that go into the pattern, besides just looking like the picture in the book or looking like the ideal setup. The logic for what creates these things is very, very important in executing them properly. Now, once I know I've got a setup, and once I know that it makes sense in terms of what the market's doing, the next thing that I do is I go through and I set my stops and my targets. And most important to me is that these things are based on logical support and resistance. I want to know that everything is based on price action, not I've had a lot of people over the years say, I'm willing to lose $500 on a trade. And my response is, or they'll say it's 1% of my account size, or it's 2% of my account size is what I'm going to risk on any given trade. And, my response is, unless you're accomplishing that by finding a logical support and resistance area and then adjusting your position size so that, your account size criteria isn't violated, you're putting yourself into a real bad position where a lot of day traders will say, I'm going to risk $500 because I've got $50,000. I'm going to risk $500. And my response is just, what makes you think the market cares what you're willing to lose or what you want to make? Right? It makes no difference. It's all about natural support, natural resistance are the places that I'm going to place my stops and I'm going to place my targets. And when I get there, I'm going to honor both of those. Now, before you take any of the positions that you're going to get from MetaStock or that you're going to get when you're flipping through these charts looking for them, you need to go through, find which index something is correlated to, right? Because there's going to come a day where something's going to get to your profit target and it's going to shoot through. You want to know ahead of time, if I'm looking at Abercrombie and Fitch, for instance, and that's a specialty retail stock, and then I'm going to go and look at the retail index, right, RLX. And if I get to the profit target and it's going to pop on through there, the first thing I want to do is not look at the chart of the stock. I'm going to go look at the chart of the index. I want to know, is the highly correlated index to the stock giving it a reason to extend? And if it is, I'm going to keep an eye on both things, as we'll see as a trading plan unfolds. And I'll cut that extension off at the first sign of trouble in the index. We want to identify also potential inflection points. I use floor trader pivots for that. That's a simple calculation. You can get a plug-in for MetaStock. I know that will calculate the pivots for you and plot them on the chart. Only reason you want those there is so that you have an idea ahead of time where price may pause or may have a slight reversal, and also, that if you get to the other side of that, you're likely to have a pop through. And then, last thing when I put my trading plan together is I want to make sure I've got a very, very objective framework to evaluate the plan in. So as I execute my trades, I import all my data from my broker, and I put this into a spreadsheet that automatically, pops things into the right place and gives me then an idea of exactly what's going on. I can see exactly what the market cycles look like. We're going to look at this in a second too. How much of the cyclical part of the market is involved in expansion, how much is involved in reversal, and how much is involved in trend resumption, and then I can get a real good feel for are my patterns also falling in line with that. So the trading plan itself, pretty simple. I know some of you, a lot of you actually, if you've purchased the Around the Horn module, are also taking advantage of the membership in the trading service that I put out. But this is what a trading plan that I have on my desk in front of me looks like every day. A little bit closer look at the entry criteria and the stuff that I'm interested in. I'm going to go into detail on why I have each one of these here when we look at the Fastball setup in a second. But let's move forward and take a look at the analytical framework before we do that, because knowing how you're going to evaluate what you're doing is definitely more important. Here we go. As you see here, these are all day trades, and these are all just the core trades on the Around the Horn service. So these are that very, very developed trading that I do. These are sitting in front of me on the desk every day. We see here that I've got a nice enumeration of how many times every pattern occurred, how many times every pattern triggered, what the profitability per pattern was, what's the overall profitability, long-short ratio, long-short profitability, and then we've also, of course, got a graphical representation of each. And what we see here is that overall this year, so far, this is 2011, we've done about 30.5 points, or 30.5% return on the account through this portion of May, right? We're at May 17th. And if we go and we just pull up one of these, oops, let's back up here. Okay, looks like I've got a little glitch here with Presenter and PowerPoint, so we're just going to look at these on the analytical framework rather than bringing up those individual charts. But what I was going to do was pull up, for instance, that pattern distribution and the triggered pattern distribution and take a look at where we are. So you can see that blue portion of the triggered pattern distribution pie is the Fastball setup. Expansion of range, expansion of volume, very big player in 2010 and 2011. So 2011 so far, that is consuming most of the pie, right? Infield fly is a reversal setup, second biggest portion of what we've been trading. So those two strategies are represented in the pattern profitability there. If you look, you can see that the blue bar at the bottom of the pattern profitability chart represents the Fastball setup. So far, that's about 11.5 points of profit on the year, followed by the sinker setup, which I told you is a reversal pattern that I developed, which is also part of this Fastball thing. You can scan for it in MetaStock. It's very easy to identify. It's very easy to spot with the ATH add-in, with the Around the Horn add-in, and then it's just a matter of setting it up according to the rules. You see that's the second most profitable, even though it's a very small portion of that pie, right? Look at the pink slice of the triggered pattern distribution. We don't have that many of them, but like I said, when they happen, they really just knock the cover off the ball. So sinker accounted for 8.25 points of the profits this year, and then if you see infield fly, which is the red bar, 6.25 points. So what I'm getting at here is really volatility is still ruling the day, and if you get on the right side of the market cycle, and you also make sure that you're in tune with what's going on in the individual indices and in these individual stocks, you can really get some very quick profits intraday, and not even worry too much about trying to carry things over when the market is really in a volatility expansion. Overall profitability, we see winners to losers and scratch stops. The winners are the blue portion of the chart. The scratches represent exits on trade, so there's a very logical way that I trade. If I get into a position, I get triggered in. Once I'm in, if the stock doesn't go 10 cents in my favor for like a $30 to $40 stock, or let's say a $20 to a $40 stock, 10 cents in my favor, something higher might be 15 cents. If it doesn't go in my favor before it goes against me, I scratch the trade just for a 10-cent loss. I consider a 10-cent loss a scratch. If it makes it 50% of the distance to my target, to my profit target, and then reverses and hits my entry price again, I'm out. I get out of the trade. The losers are stocks that actually went to the stop loss after triggering. And if I hit a stop or I hit a scratch stop, I'll take a second entry. So it's really just that simple. And if I get to my profit target, I plow through it. I'll exit on, I've got a couple criteria: reversal of two closing prices, or a fib extension, or a parabolic SAR, right? So I use a couple different methods to get out if things are really going in my favor. But for the most part, I'm always taking something off at the profit target. Now, if those of you who have been to my seminars or presentations before look at the long to short pie chart there, you can see that this year is definitely looking very different than last year. So even though the market's making all these new highs, last year we were mostly long. It was almost an inverted pie chart of this here. What's red would have been blue, and what's blue would have been red. And what this indicates to me is that the market's at a top, or it's at least stalling out, or we've got a lot of stocks that are at tops. And I've been focused almost entirely on the short side. And if you look at the long to short profitability, you see that most of my profits are being generated from the short side of the market right now. So it's all interesting stuff, but what you should really get from it is I'm really trying to anticipate market cycle and impose market cycle on my analysis every night before I get ready to trade, right before I put these setups together for the following day. Now I'm going to skip a couple slides because these are just where these charts would have been. And we're going to move into sort of the logic behind what I'm doing right now in terms of capitalizing on volatility. So first off, as I talk about in the new book, in Trade Secrets, I think volatility is it's a pretty simple concept, and you don't really need to measure volatility all that much. You just need to sort of wrap your head around what it is that differentiates the types of volatility, which I would just say are good volatility and bad volatility. Good volatility is going to be predictable. You have a trending set of price behaviors that generate the volatility, and it's going to be mean reverting, so that you can predict that price is going to move back to an average volatility range, right, in terms of expansion behavior that's going on in the markets, versus bad volatility, which is very unpredictable and occurs in the absence of a discernible trend. And once you get that kind of volatility going, that of course is the price action that really tends to chop you around on an intraday time frame, and also on some of the shorter term swing trades. So very, very simple concept, right? Mean reversion. Somebody always asks, well, what's mean reversion? You've got an average, that black line there that runs right through your, say that red line is volatility. The black line is the average volatility that's in the market at any given time. The red balloons represent high volatility, and the blue balloons represent mean reversion. All mean reversion is you're headed back towards that center line, and you're oscillating around it. As long as that is evident in what's going on in the markets, you got a market that's easy to trade. Now, let's say everything's in place, which I think it is currently. You've got good volatility in the market. You have for the last 18 months. It's been very, very good trading. And how do you capitalize on it? Well, in my intraday trading, favorite setups are going to be the ones that really hit around volatility, because it's going to get me in and get me out fast. So on an intraday time frame, on the day trades, I'm really looking to establish a position and not be around that long before I hit the profit target, because volatile markets tend to do some pretty serious reversing over the course of a session, not just over the course of weeks. But the fastball setup, definitely bread and butter trade. It's in around the horn, a trader's guide to consistently scoring in the markets. It's on an intraday time frame. I trade it straight up. I trade it against news events, which is a strategy that I've talked about in Trade Secrets, and I trade it on high reversals. Sinker is a 52-week high reversal. It happens on a fastball setup. So like I said, if you're scanning for these in MetaStock, really all you need to do is read up on the sinker strategy or focus on 52-week highs in the output that MetaStock gives you, and then apply the same rules as the fastball setup. You're just looking for the reversal. Swing and position trading, I also use it in big picture expansions of range and volume setups. Those occur when the market is a little bit less volatile. So when we got less volatility on the intraday time frame, I start shifting out and looking for opportunities to position and swing trade these strategies. All of these strategies are suitable for any time frame. It's a very robust methodology. It's all about cyclicality, so it's very portable. It will work equally well for position trades and swing trades as it does for intraday trades. My partners in the hedge fund are using a lot of these ideas. Art Collins uses it in the futures market. Tom and Corvia uses this stuff to trade medium-term swing trades. It's all just a very logical way to approach the market. So let's talk about this fastball setup. Quickly, let's go through the rules. I know some of you have seen them before. I recognize some of the names here. Some of you are new to it or probably just started using the plugin. There's two types of setup. The first one is going to represent a pattern that starts with a pullback and a trend. So you've got a stock that's been trending and then starts to pull back. I want to see a directional breakout. So I want to see a breakout in the direction of the original trend, with the move being the widest move of the past 2 weeks, so the past 10 trading sessions. And volume on that breakout day should be higher than the average daily volume during the pullback. And I also like to see these things close in the top 25% of the bar. In the case of a long, in the case of a short, the bottom 25% of a bar. And the closer to the extreme of the bar they are, the better. On the trigger day, we just enter the trade a dime beyond the extreme of the breakout bar in the direction of the original trend. So somebody always asks, well, that 10 cent breakout, is that confirmation for a $100 stock just like it is for a $10 stock? So obviously the answer is no. I'll use 10 cents for, let's say, from all the way up to about $60. And beyond that, I use the intraday price behavior of the chart to determine whether or not I should be widening that a little bit. So if I look at a chart of a stock that's trading at $75 or $80 a share, so let's say that we're looking at CSX. CSX trading about $73, $74. I'll use a 15-cent entry criteria if it looks to me like that stock typically has a wider travel range per bar. Sometimes they do, sometimes they don't, than a stock that's trading at, say, $50 a share. Here's what it looks like. This would be an ideal looking setup. On the long side, on daily bars, you would have a move to the upside coming up on that red arrow there. That's followed by this pullback labeled 1. Then you've got a breakout on volume, widest range bar of the past 10 sessions, closes high, right? Closes in the top of its range, and you're going to see lots of buying pressure going into the close. The following session, pretty simple stuff, just going to enter 10 cents above the high of the bar labeled 2 in the bar labeled 3. The type 2 setup, same logic, but now you've got a consolidation that happens. So you got a trending stock forms a 5 to 15 days, so I'll go a week to about 3-week consolidation. It breaks out of the channel. It's got another directional move, widest move of the past 10 sessions. Volume should be really higher than average daily volume in the channel. And enter 10 cents beyond the extreme of the breakout bar in the direction of that powerful momentum. Here's what this one looks like. You've got the trend to the upside, gets you into a channel, moving sideways 5 to 15 sessions. In the bar labeled 2, we've got an expansion of range, expansion of volume. We're going to look to get long 10 cents above that bar in the bar labeled 3, so that would be the following day. Now here's a caveat with this one. With all the volatility in the market, a consolidation version of a fastball setup, I will take contra trend as well. So if that consolidation there in that area labeled 1 was after an uptrend, and then that bar labeled 2 broke downwards instead of breaking up, I would take that trade as well. I would take a short side position against the consolidation version of it. On the pullback one, on the type 1 setup, no dice, right? That one's got to be trend following. But on the one that's going to break out of a consolidation range, I definitely, right now anyways, will take them in either direction, just because of all the volatility in the market, and we've had such an extreme move, and we know that there's mean reversion at play. It just makes for a very logical trade, contra trend, when you've had a consolidation, because it indicates that people have had a lot of time to think about it, and when push came to shove, maybe they decided going to dump this thing at the first sign of trouble, and that volatility is going to get more volatility and more selling, and you get nice contra trend moves with this setup as well. So when you're scanning for them, if you get the type 2 setup, if you get the consolidation setup, you're going to want to look on both sides of the market as long as we've got an extended market the way that we do. Now, let's go and take a look at an actual trading plan recently and how this thing played out and what it was that we were relying on in setting the trade up, and what the logic is between finding a pattern and deciding that it's suitable for the intraday trading plan. So we see here it's Barnes & Noble. It's a fastball setup. I've got a long position in this case. Entry is $12.44. I've got a stop at $11.92. We're going to go over each one of these levels. And the initial target at $13 and a penny. I got a ratio of 1.1 to 1 on the trade. So as long as that number is greater than 1, I'll include it in my day trading plan. If it's less than 1 to 1, I scrap it. I'll put it on my stocks to watch. I'll put it on my stocks and sectors on the radar. For those of you who listen to that at Trader Insight, that's up there every night. That's just stocks that I'm looking for in terms of scalp setups. I've also got the 50% to target area identified here. Remember, if I enter a trade and I get 50% of the distance between the entry and the target, I move my stop to break even. Got the sector identified. Barnes & Noble's in the retail sector. In the event that I get a profit extension, I'm going to want to go and take a look at the sector chart, see what's going on. Is was there news somewhere? Is the sector really running? If it is, I'll let the profit extend, and if it's not, then I'm going to look for the doors as soon as I see any kind of sign of trouble in the position. I've also got the floor trader pivots identified. Again, each one of these is identified solely because these are inflection points that we're going to run into over the course of the session, and I want to know where they're going to be. A lot of people rely on them, a lot of people focus on them, and that's enough to say to me that the crowd psychology is going to affect what happens when the stock gets to those price levels. Now, we looked at the stop, and I told you before that I rely very heavily on natural support, natural resistance in everything that I do, right? So I don't really do much by way of, like say, fib resistance or fib support levels when I set my stops. I will overlay them to get confirmation of what's going on, or try to see if I can find other things. If there's a couple areas that I'm looking at as potential stops, I'll lay some other things on top of a chart to see where there's a confluence of different indicators that people might be watching. But my primary focus is going to be, where do I see support and resistance? So in the case of this setup, right, we saw on the intraday trading plan that I had a stop at what was it, 1192, I think, and we see that that area is in the top of the chart there in the blue box. That's where we see a logical, if it breaks down below that, I see where it's going, right? I see that there's a pretty significant reason to assume that price is going to retrace down into the day's trading range. I also see there's very, very heavy volume around the area that I'm identifying as a logical stop loss. So that all makes me happy. Now I see that there's heavy volume going into the end of the day. I see that I'm closing in the top 25% of the bar, right? So if you're running those scans and you get these things, that's not the end of the day. That's not where you say, okay, I know what my day trades are going to be tomorrow. I'm going to go and just power through these because I've got 5 fastball setups. You want to take those fastball setups, break them out onto 5-minute charts, and say, where's the support and resistance? And can I logically assume that everything that should be in place for a fastball setup is there? Was there heavy volume going into the close, that it closed high in the range? That's going to indicate to you that somebody's got something to get done that they couldn't finish, right? They're buying into the close because they thought if they waited it out, price was going to come back in, didn't come back in, now they're going to buy it at the day's highs. I'm also interested in the fact that this area at 1192 that I identified as being the place I want my stop loss happens to be the volume weighted average price, the VWAP, for that last leg of the trend move into the close. So that tells me, since I know I've got a lot of clients who are floor traders, and I know that they all tell me that what they really rely on is the volume weighted average price as a determination of whether or not they're doing their job right? They want to be on the right side of the VWAP. I want to be on the right side of the VWAP too. So the fact that my stop loss is going to take me down and through the volume weighted average price, which is going to be a sell signal for those guys too if they happen to be holding stock, that tells me I've got everything in place in terms of a stop that I want. Now when I set my profit targets, it's going to be the same thing, except since these are intraday trades, these are day trades, I'm going to want to bump out a time frame. So for my profit target, right, I want to say, what's happening in the bigger picture? Where is the significant support and resistance going to come from when I'm planning a trade? So here, as I'm looking at the daily chart, I see that initial target around $13, $13.01 was actually the level that I had picked for that day. But if you look at that blue line and you look at it go back through price, we see lots and lots of opens, closes, highs, and lows that revolve right around that price. And we see that there was back on the chart, like right above the A and daily chart there was pretty significant support and resistance at play when price was working there before. And when price came down to the right of the chart, right, as price was making that steep decline down into that fastball setup there, where we had those 2 consolidation ranges and 2 fastball pops. The last one is the one we're interested in right now. But when you look at what happened when price hit that blue bar, it paused. People thought about it for a couple days, and then boom, it sold off. So that tells me that when price gets there again, their body's buried there, right? There's people who didn't get out. There's plenty of people who said, boy, if it gets back there again, I'm gone. I'm going to get out at break even, because that's where they purchased this thing to begin with, and they missed getting out. So that tells me that's a logical place to put my initial profit target on a day trade. Now we move out to a weekly chart. So I always do it the same way, right? I set my stop, then I go out to a daily chart to look for a target, and then I bump out to a weekly chart and I look to see right around my profit target, am I going to see the same kind of confirmation as I did on the daily chart of the target that I just set. And in this case, I see there's lots of opens and closes right around 1301. Usually I like to see even more activity around that price. If you scroll back on the chart, you scroll back through time, left on the chart here, and you're looking for last time price was around this level. What did it do? Time before that, what did it do? Time before that, what did it do? And if you see that there's lots of support and resistance there, again, this is all confluent information. This is all stuff that just goes through and affirms your choice in which ones of the setups are going to make the great trades and which ones are going to make the not so great trades. Now, when it comes time to trade the plan, this is pretty simple. All I do is I draw the lines on my chart from the trading plan, right? So I know exactly what was the stop, what's the target, what's the entry, what's 50% to the target. And here we see, stock got into that, got through the targeted entry price or the stated entry price, moved to 50%, got right up to the target. So in this case, we didn't have to concern ourselves with what happened at 50%. But take a look at how close we were on calling those targets. A lot of people who have been on this trading service have sent me emails wanting to know, is it a function of the fact that, I've got people who are trading large shares, or is it a function of the fact that I've got a lot of people on the service or something? It's not. We limit the trading service to 40 clients. And at any given time, we don't even have 40 clients. It's not about their buying and selling activity that these targets hit. These targets are being taken out, even if it was just me trading it, at those target levels, because they represent significant support and resistance in multiple time frames. Traders who are trading intraday, swing traders, and position traders all have a vested interest in what happens at that level. Something's going to happen in their trading based on hitting those levels, because we've looked at the intraday time frame, we looked at the daily, we've looked at the weekly, we looked at, we bumped out as far as we could in setting these things up, and that's why we get those reversals. It has nothing to do with with me or the number of people I have trading or the numbers of shares that I trade or anything else. The other interesting thing to look at here is the stop. So we identified that support and resistance level on that intraday chart the day before, and look at the price activity right around that stop level before it moved up to our entry. I like to see that kind of thing in the morning. I like to see that price is hanging right around the stop. I don't make any adjustments if I see this kind of price action happening, because what this tells me is when price gets to that stop level, it finds support. And if it doesn't find support once I'm in the stock, I don't want to be in it. So why does this thing work? Again, I said volatility usually begets volatility. You've got increased range and an increase in volume going into the close. That tells you an institution is probably buying or selling, or at least a lot of individual traders are interested in something. Most likely that's going to carry over across multiple sessions until you see the buyers, the guys who are looking to put on a big position, get to a point where there's a lot of supply. A lot of supply is represented in this case by our profit target, right? Once it gets to the profit target, the reason that it's turning around usually is that there's a lot of supply right at that level, and the guys who are looking to get their orders filled can pull it off. They can get the large size that they're looking for into their account, and they're done. And once that happens, the buying tapers off, and we see the move back down into the range. If it resumes its trend, that's a whole other story. We're going to look for those in switch hitter setups or 3-2 pitch setups or any other of the other setups that we're scanning for every night. Now, again, the new book that I wrote, Trade Secrets, is all about vertical integration. And if you have a pattern that's robust, and I'll tell you flat out, all these patterns are robust enough to work across multiple time frames. Volatility is really the only thing you need to look at in terms of determining whether or not you want to put them on as day trades or position trades. And it used to be the case, way back when, everybody told you can only trade in one time frame. And I'm going to say that I used to do that myself, and the reason for it was brokers weren't really that good at what they were doing. So they were great at giving you day trading direct access, or they were very good at portfolio management. But I remember way back when, I'd be trading Qualcomm or something, or I'd be trading Amazon, and you'd have a day trade on, and you would say, well, gee, if I have a position of this that really goes strongly in my favor, I'm going to carry it overnight. And the next morning, you'd get to your desk, and the stock wasn't there, and neither was the money, because they were very, very bad at bookkeeping in the late 90s if they were day trading firms. And if they were swing trading firms, or if they were traditional portfolio firms, they were very bad at handling the intraday trades because they didn't give you direct access. That's all changed. Right now, if you have an account and it's with a reputable direct access broker, you can manage positions in there just as easily as you can do your intraday trading, and you don't have to worry about it. The margin's all handled for you, margins segregated on the different types of trades, and if volatility dictates that you shouldn't be on an intraday time frame, you can bump out and get yourself into an expansion range and volume setup, just like this fastball setup that we just looked at, that works just as well or better in the longer time frame in terms of handling increased volatility. So here's my caveat on this whole thing. I never take a day trade and turn it into a position trade. So if volatility told me intraday trade was what this was supposed to be, I can it at the end of the day no matter what. I'm going home flat. If volatility told me this position that I'm establishing should be carried over multiple weeks to approach a profit target, that's exactly what I'm going to do. I'm not going to pull the plug on it during the day because it's making me nervous or I don't like the way that it looks. It's all about sticking to your trading discipline. Never let a day trade turn into a position trade, and never day trade a position. Now let's look at what these big picture trades look like. I'm not going to go over the rules. It's the same rules that we had for the fastball setup in general. I just want to show you. You can go and scan in MetaStock, find these things on a weekly chart. You see the fastball setup there on the heels of a pullback, sort of consolidation hybrid. It's a little bit of both. We see that pop to the upside. We see that up above on the weekly chart, we've got nice resistance at some tops, and those tops happen to overlap with places that we saw support and resistance as that initial big wave move was happening. So in this case, and this was a while ago, right? So it's been a great market for the intraday trades. I like intraday trades better, quite honestly, than I do positions. But back about a year and a half ago, or a little bit more, market was a little bit harder to trade intraday. Not as many opportunities coming up, but there were plenty of opportunities on the weekly chart, so this was one of them. Going to set stops, just going to look at the time frame that I'm trading in and find a level that represents a lot of support and resistance, just the same way that I'm looking for support and resistance on my profit target. I'm looking for it once again on my stop loss. And once all these factors are in place, I load it into the trading plan just like I did before. If I've got better than a 1-to-1 risk-reward ratio, I'm going to go with it. Typically, it's going to be the case that on a weekly chart, you're going to pass on more trades than you do on the intraday charts or on the daily charts. Just the nature of the beast, right? When you've got a trend on a weekly chart, sometimes those pullbacks leave you with support and resistance that's a lot further away than your target might be. So you just pass on the trade. You don't do it. In this case, you've got a weekly chart with lots and lots of support and resistance on heavy volume right around the area that's identified as a stop loss. Makes for a good stop on the trade. Now, if I go and trade the plan, I go and execute the trade, I see I've got, in this case, the entry and a move right up to the level that represented our profit target. Stock after that could go to the moon for all I care. There's going to be a pullback. Might not have been as deep as this one. Might have kept shooting right up. But I know that based on my style of trading, there's going to be an excess amount of volatility at that level, right? There's going to be something happening, and it's always the same thing in my head is I know there's bodies buried there. I know there's guys who are looking to get out of a position that they established back, where we had shown the support and resistance that identified the target level. I know there's guys who've been sitting on that stock ever since it was there who've been saying, geez, if I just get back to break even, I'm out. And that's a very powerful force. Fear and greed, right? I'm a psychologist. Fear and greed are not just things that appear in market textbooks. They're very, very real psychological phenomena, and they cause people to do all sorts of crazy stuff. And if they're going to act on it, I'm going to make sure I anticipate that reaction before it even happens. And that's what all this stuff is about. So with that, I'm going to let Kelly talk to you for a minute, and then I will take any questions that you have. I'm just going to grab a sip of water.
Okay, give me just a quick minute. I'd like to show you something on my screen. So I'm just going to open up a new pod here for just a moment. Okay, you should be able to see my screen now. That just shows a little bit of the Around the Horn add-on. So what I'd like to show you here is just some of the different patterns that the Around the Horn add-on comes with. It definitely comes with the Fastball pattern that Dr. Manz has been discussing today, as well as the line drive, backdoor slider, double hitter, infield fly, 3-2 pitch, and switch hitter. Now, what's great about this add-on is Dr. Manz has taken the time to prepare an introduction video to each of these different patterns. So you can actually go through here and you can actually just view any of the different patterns that you'd like to watch and understand more about. And that's what's great about this add-on, is he's really taken the time to give you some great information, some great videos showing you how to use these patterns. And down here at the bottom, you also see you also, when you purchase the add-on, you get a free month of the Around the Horn intraday trading plan as well. So the actually, C-Smart, thank you actually very much.
Yeah, sure. I'll speak to. I see Barry has a question there, a point that he made, and I want to address that. He says BKS averages 1.2 million shares traded a day, 16,600 every 5 minutes. He doesn't feel that that's very liquid. Now, in my personal trading, I'll tell you, 1.2 million shares per day is a pretty heavily traded stock as far as I'm concerned. I trade stuff that's between 300,000 and 3 million shares per day, or 5 million shares per day. That's primarily because when you're looking for these setups, you're looking for things that have a lot of potential to move on momentum, or a lot of potential to move when buying or selling is going to come back into them. When I see heavy buying or selling on a stock that only trades 300,000 shares, 500,000, 800,000, whatever shares per day, that tells me it's going to move pretty quickly in my favor if the buying or selling continues in the following session. So if you go back, as a matter of fact, Barry, I would highly suggest you do this. Go to traderinsight.com, which is our website, and then click on the blog. And what you can find there is a record of all the Around the Horn setups going back. Man, I don't even know how far they go back. They go back at least a couple years or a year. And then, if you want, you can also. I believe there's a trial that comes with the MetaStock add-on to the trading service, and you can go back and then take a look at all the trading plans going back better than 4 years are maintained in an archive on the site. And if you look at the performance on those and you look at what happened, you'll see very quickly why it is that in my personal trading I focus on stocks that are what some people would consider small cap or mid cap stocks. Now, I'll qualify all this and say when I do my trading on behalf of clients, I shift the focus to big cap stocks, because typically the clients, fortunately or unfortunately for me, have a lot more money than I do, and they're trading blocks of shares. I'm usually trading, you'd be talking about somebody who's trading 20,000 shares in one sweep. I'm trading 1,000 or 2,000 shares in my account, depending on whether Julie and I are trading together or I'm trading by myself. So, therein lies the difference. But proportionally, when I'm trading for Trireme, when I'm trading for the fund, the amount of pressure that I'm exerting on the market by implementing my trade is proportionally identical to the amount of force that I exert on the market when I trade in my own account in those less liquid stocks. Max, I'm going to be honest with you and tell you I don't know what a Darvas box is. I would say this to you. You can go back and you can look at, if you look at the methodologies that have worked over time in the market. If you go all the way back to reminiscences of a stock operator, what you're going to see is that the simple concepts that I present are the ones that have worked over time. And I know you can slap a lot of stochastics and oscillators, and every kind of an indicator on a chart and say this is giving me an edge. And my response is always going to be, it's giving you an edge right now, but things are going to change, and you're not going to know when that edge is going to stop serving you. And in the case of the style of trading that I do and the style of trading that I advocate, or what I've learned over the years from following what's caused people to have success and what's caused people to fail, if what Darvas focuses on is price behavior, then I say right on, because price behavior, I say price, volume, and time are the only things that matter when you're looking at a chart. If you've got a charting package that can give you that, then there's not an indicator in the world that you need. You don't need something to tell you what happened. You need something, you should be able to eyeball a chart and see what happened. You don't need a stochastic and all that stuff for it. So yeah, my stuff is definitely going to overlap with some of the classic chart pattern reading, chart reading, tape reading stuff out there. How many trades on average in a month? Well, it's not, I can tell you quickly what I've done in 2011, so it's kind of dependent on the year as much as it is on anything else. In the month of May so far, we've done 18 trades. In April, which was, let me just make sure of something here because I got the spreadsheet in front of me. Yeah, so April was about 20 trades. March was a bigger month. March we did just over 8.5 points. We did 31 trades. In February we did 34. In January we did 31. So those are round trips. So you can see it's not a very frequent trader. So a lot of people are frustrated by that, right? So I get guys who are who are definitely in it for the action, who tell me, there's not enough setups, there's not enough days that you've got 4 things that trigger. There's a lot of days you're just sitting on your hands, and my thing is I don't care. Most days the best use of my hands is a seat cushion. If if there's opportunity and it's a setup and it goes in my favor, then great. If it doesn't trigger, if it doesn't head up to my entry price, then I'm not going to fool with it. Month of May is, hang on, we are currently at $4.28 a share. So, anything can happen in the rest of May, so we will find out. Let me just read these questions here. Future upgrade of ATH. That book has been out since, the first edition. That book's a bestseller and has been out since 2003 and is updated every year. And really, the only thing that's updated in it are not every year. It's updated every 3 years. We're on our 4th edition of it actually. But what's updated are the examples so that they reflect what's going on in the current market environment. We've had examples from flat markets. We've had examples from trending markets, strongly uptrending, strongly downtrending. As long as there's market cycles, I can tell you I'm going to be trading this methodology. I've been trading it for 13 years. I really haven't changed what I've been doing, and I would venture to say people have been trading exactly this way for the last 100 years, if not more. Just reading Max's question. So would you say the most important being price followed by support from volume with an indication of time? Yeah, exactly. Oh, the plugin. Well, if the plugin needs updating, I will certainly work with the folks at MetaStock to update it. How did I arrive at my approach? I actually did. So my background is I was I went to the Drucker Center at Claremont. I was a major in international business and finance, and I got a PhD in organizational behavior. While I was working on that, I got fascinated with number crunching, right? I was just really into the statistics. Most of the stuff in Around the Horn was developed through the use of multivariate statistics. When I first wrote the book, it was all about ANCOVAs and MANCOVAs and getting covariating things out of price behavior, figuring out what was going on. And my publisher looked at it and he said, "You're nuts. Nobody's even going to read this thing because nobody's going to understand what you're talking about." Took it back, worked it through, really just was looking at, what are the statistics really telling us? What's all this mean reversion stuff really getting at, and what are the statistically significant pattern behaviors? What are those actually telling me? And what I found out was all that number crunching that I was doing really wasn't giving me any better indication of what was going to happen in the market than just going through and looking at the charts. Very, very similar to running stochastics on charts or running a bunch of moving averages on your chart. You really don't need the math to show you what it is that's happening. What you need is a good understanding of how markets work, or a good understanding of how market cycles work. What's a liquidity cycle like? And then you look at a chart, and it's pretty easy to pick out what it is that's happening underneath there statistically. Now, in Around the Horn, there's still this pattern called Baltimore Chop, which is a straight up statistical mean reversion thing that you have to run a very simple statistic on to figure out. But other than that, other than knowing what two standard deviations are, you can just plot, heck, you can plot Bollinger Bands on a chart, and you're off to the races. You don't even have to know what the stat does, once you get the concept. But once I had done this work and wrote a bunch of papers on it, I realized, boy, it's not just easier, it gives me a better flavor of what's going on in the market if I just look at these things and get the gut reaction for them. So that all started in 1990, and by the time that we were trading for a living, I wasn't doing any more. I wasn't doing any more of the statistical computations on these things to figure out what was going on. The price for the two books is. I know the cover price of Around the Horn is $95. I think it's at Trader Insight. Both of them are available for $59 a piece, and I think they're both available at $59 a piece on Amazon. Trader Insight does free priority mail shipping if you are in the United States, and Amazon, I think they qualify for free shipping if you're buying them directly from Amazon and not one of the other stores that sells on Amazon. So they're about $59. We are all about, Barry, that's a great question. We've been approached by everybody wanting to know about this, right down to reality TV show people who've been here and said, you guys, where's the where's the anger, where's the rage, where's the don't you guys fight about this stuff? And the answer is no. We've just got a really good relationship, and that's important with any trading partner. I think everybody should trade with a trading partner. I think as long as there's a plan, as long as this stuff's laid out ahead of time, and as long as you agree on the, she helped me develop all this stuff in grad school, these projects. That's how we met. And we just both really believe in it, and it's really worked out well for us. It's enabled us to not have to work outside the home. We've got a great relationship with our kid. We've got a 3-year-old here now who gets to spend all of his time with mom and dad because we're doing something we believe in, and we both have a personality that's pretty even keel, and we don't fight. We're not arguing about this stuff. If you read the plugins that come, the descriptions that come with the plugins. I mean, the descriptions that come with the plugins are pretty good. It's all about whether or not the concepts make sense for you. I would say The plugin has a real good description of the stuff in Around the Horn. It doesn't have a description of the stuff in Trade Secrets. Stuff in Trade Secrets is going to go and enhance the profitability or the profit potential of what the plugin will do for you. It's just Trade Secrets was developed afterwards, so I didn't, I didn't include any videos for any of those patterns. But they all rely on market volatility or the volatility expansions and contractions to generate profits. So, if you're looking at the two books and you've got the plugin and you only want to buy one of the books, I would say Trade Secrets is the one to grab. But they're both fantastic, if I do say so myself, right? Anybody else? I'll stay as long as you guys have questions, by the way, and as long as Kelly's willing to hang out. Right now, the percentage of trades that are day trades is 100%. So I am currently focused entirely on the intraday portion of the market. That's because volatility favors shorter term trades right now. We've got a lot of swings, and here's the caveat: I happen to feel that we're at a top. So I felt for a while that we're at a market top. So if I get setups that would indicate that they're position trades, I would definitely lack confidence based on the part of the liquidity cycle that I happen to think we're in. I would lack confidence in putting those positions on, and that's going to affect my psychology when I go to set up, support and resistance stops and all that stuff. So, until we get a pullback in price, in the indices and in the individual stocks, I'm going to be looking to day trade this stuff. Once we see a significant move to the downside in this case, since we're pretty extended, I'm immediately going to flip and start looking for position trading opportunities. And at that point, I would say it'll probably be a quarter position trades to 75% intraday. I do position trades for shorts. Yeah, I would definitely position trade a short, but I would only position trade it in the case of a market that's currently trending to the downside. So I'll take lots and lots of opportunities. If you go look at the blog, you'll see there's tons of short side trades, right? This year has been dominated by the short side, but I don't really have the intestinal fortitude to start trying to second guess the market in short tops. This thing could wind up just blowing out and really going up for a long time. And with the intraday trades, my focus on that is, as I said before, I don't do a ton of trading. So I don't do 30, 40, 50 trades a day like a lot of people do. I do that number in a month. My intraday trading is all about controlling risk. So believe it or not, I think you can control risk much better on a day trade than you can on a swing trade or a position trade. So, and it's been my experience that, I've got really good profitability on the day trades, and, I'm in and out over the course of a session, and when the market is doing something abnormal, I don't worry about it. If I was going to do something, if I was going to look for a reversal here, I'd probably be looking at an options play. All right, well, if there's nobody else, then I am going to thank you folks for showing up. I hope that I hope you enjoyed it. I hope you got something out of this. If you have questions, you can just shoot me an email, Adrian, Adrian, @traderinsight.com, just like it is there on the introduction slide. I will make every